Hey traders, Nick here looking at stocks after hours. I thought I would spend a couple minutes on ZIM, so this was a happy moment, a new stock to me. I had no clue it existed until one of my members, longtime member and friend, Jake, suggested it. He said, "What do you think?" I said, "Whoa, it looks like it's breaking out, and as an investment, I don't like it. I think it was here somewhere. And but as a trade, it looks like a clean breakout with a strong P&L behind it. It has legs. How much? I thought it would be as much as this. So the extension was almost perfect. I'm not that accurate with it. I know that, they usually play out quite a bit. So this is pretty darn close, right? So I said, okay, you know what? I may trade it with you. And I bought a call for April. And then I found out about the dividend. So I figured, okay, CNBC might want to pump it or somebody want to chase the dividend. And boy, is it a dividend. What? $17. $17. Ex-div date is the 22nd. I believe that's tomorrow. And herein lies the warning. Okay, this is something that I wish I had somebody warned me about a long time ago. So part of my trade was I bought a call and then this happened. And somewhere around here, I said, I better lock my profits. I sold a call twice against it. I sold a call and then it played out. It died in my favor. And then I sold another call at 87, shorter term. So I was long at 85, short at 87. So I basically had a debit call spread, but it wasn't a vertical spread. This is a typical debit call spread. I buy a call, I sell a call. This is called vertical. Mine was a diagonal. See, it goes diagonally because I jump time and jump levels. This allows for easier management. And sure enough, I needed it because it closed the Friday. It went above 87, but then it came back down on Friday. So it was a big win, long story short. And I closed the whole thing. Why? I don't want to be short a call, even though the trade is bullish. But I sold a call that's close to the money. And ex-dividend day is tomorrow. I didn't want to chance it. Why? Because they can exercise you overnight and you may end up owing the dividend to somebody. Find out more about it. I'm not from Wall Street. I'm not giving advice. I'm saying you might want to call your broker and find out more. What happens if I'm short a call on ex-div day? What could they do? So you want to find that out. Because normally they would say, they're not going to exercise you if you're above the money. By the way, that is a fallacy. They can exercise you anywhere. Price does not have to be above your strike, especially in this case, because they have $17 to play with. So I think they could still make money if your sold call was here. Be careful. So make the call and say, this guy pays $17. Do I have any excess risk overnight? Am I going to be assigned the short position? Even though I'm long this one, what if I wake up short the stock temporarily? Yes, I'm protected from this, but what about the dividend? So who pays the dividend? If I sold the stock I don't own, that's me being short. Do I have to pay somebody the dividend? I think the answer is yes. So ask your broker, do I have any extra risk from being short a call that's close or in the money from a winning trade? Just ask them. Okay, so enough of that. How do I trade this after the fact? I would imagine it's going to dip on earnings, on the payout. So let's see what happened last time. The stock rallied into a failing point and then came back and took it out. See that right there? Came back, touched it. All right, I've got footing. Let's go. Came back to the failing point, came back, took it out. They never came back to touch it. That's how the breakouts usually happen. You break out, you touch for footing. That's how it happens. So this one ran a lot. So what's wrong with it coming back? So I just added an alert. Hey, let's go check on ZIM again. So I don't want to deal with it up here. They can have whatever they want. When they come back to here, okay, so maybe I'll get long here somehow. Sell a put spread, sell a put to own shares, something. I don't like buying stuff. So this is ZIM. My PSA is if you have a debit call spread, so this is a debit call spread. They call them vertical spreads. Debit because I pay and I collect. I buy and I sell. Together it's called a debit call spread. It's a bullish position. The maximum risk should be me spending the money to buy it. In this case, it could be Not sure. It could be more because this one might create a risk because it's in the money or close to the money. So mine was a diagonal. This is called a diagonal. Still a vertical. It's still a spread, but it's not vertical because it jumps time and it jumps level. It is diagonal. It's still a debit. I like these better than the verticals, but it's still, I'm short a call at ex-div day. Whew, I don't know if I want that. All right, that's it. PSA done.